Hey guys, Dean here. Today I'm going to talk about how to invest in index funds for beginners. This includes ETFs and the S&P 500 and why it's a good idea to proceed forward with these investments. So let's go over the reasons why you should invest in index funds. Now it doesn't matter how old you are, as you can see I'm very young. I do have some holdings and investments in these funds. This is one of the best investments even for young people who don't have much money because they have plenty of time for it to compound as time goes on and they have many years left before retirement. So let's go over a few reasons why you should invest. So the first one is money loses value over time due to inflation. So as the years progress and prices skyrocket, your money basically has less value due to the fluctuations in the market in multiple sectors and the depreciating value of normal fiat currency. This is why investing is a positive outcome for you, because basically your money will gain interest over time as it sits in an investment, for an example, and it'll either stay the same as the value as it was many years ago, or will raise higher and be worth a lot more than the initial investment is. Even modern saving accounts credit you with a very tiny measly return. For an example, you can witness some really low figures nowadays like 0.1%, 0.2%. You're never really going to find anything close to 1%, which makes it so hard to actually gain any return on any investment. And since most common people aren't going to put that much in a savings account, the amount that you're going to get as a return after even tens of years is literally minuscule, and it's not really even worth doing. Investing in index funds and ETFs is generally just a low risk way to invest your money, with solid returns providing you have enough time for compounding. Obviously the older you are, the higher your investment's going to be because you probably have less years left in your lifespan or before you retire, so there's less years for you to have your investment to compound before you actually need to spend it or utilize it. For an example, if you're 20 or 23 like me personally, you have so many years left for your money just to consistently just keep compounding. This is why investing in index funds is extremely powerful for young people like me, and why I've actually chosen it as part of my investment strategy in the recent months. So let's go over what is an index fund and what makes it so powerful. So an index fund is basically a variant of an EFT, aka an exchange traded fund. You may see me say EFT in certain parts of the video. This is just a residual habit, but it's an ETF, exchange traded fund, or it's a type of mutual fund that tracks the performance of a specific index with the goal of matching the performance of that index as closely as possible. You'll see this in the most well-known index, which is the S&P 500, which you see constantly people talking about on YouTube and other websites online, because it's probably one of the most powerful to invest in, and we'll touch on that a little bit later. Now, for an explanation of what is the S&P 500, well basically it's just a conglomerate which tracks the performance of the top 500 companies in the USA. So the companies which perform the best in the given year, for an example, this index tracks those different companies. So investing in the S&P 500, let's say you invest $1,000, it'll split your $1,000 investment over the 500 companies. So basically, instead of just investing in one stock, it's going to diversify your investment over 500 different mini micro investments, if you like. This makes it an extremely wise investment and a lot more safer than putting all your money in, say, just Tesla, for an example, and hoping for it to go to the moon. So why should you actually invest in index funds in the first place? Well, first of all, it gives you broad diversification over many different fields in the market, for an example. So instead of investing in specific stocks and having to individually choose each sector or market which you think is going to perform, which is more of a gamble, you basically invest in a much more diversified set of different markets instead of a few different specific ones or sole investments. So to make this make more sense, you're basically investing in one big fund which tracks those 500 companies instead of splitting your investment into individual stocks per company, for an example. This increases the likelihood of a solid return and also minimizes risks. And this spreads your investment across many different companies, spaces and fields, and it basically makes your investment portfolio a little bit more safer in the long term. The more you invest, the more your investments are spread across all those different companies which are tracked as part of the index. Now, the next note which I put down is the low fees. It's generally relatively cheap to set up one of these accounts. So for example, in the UK, you can set up an ISA account, which is basically a very tax effective account for investments. You can do this for a very cheap monthly fee, and in the USA, you can set up a very similar brokerage account with fairly cheap rates. Both similar accounts in the UK and the USA have very similar tax effective thresholds per year in terms of the annual investments that you can put into any kind of stocks or funds that you invest in. For an example, in the UK, the main most powerful account, which is the ISA, lets you invest up to £20,000 annually completely tax-free. After this, you will obviously have to be charged capital gains taxes on any profit that you make off those investments, but as long as you stay in this threshold, it's extremely tax effective and really powerful. Especially if you're young, you probably won't even have 20,000 to invest in that specific given year anyway. Now the next one is attractive return rates. So as mentioned earlier, competitive saving accounts nowadays are really low in terms of what they're offering. They're not exactly what they used to be, and it's hard to sometimes even find anything close to 1% like we mentioned earlier, with many accounts offering 0%, or if they're a savings account, 0.1, 0.2, 0.3 if you're lucky. The numbers look a little bit bleak, especially if we're taking into account inflation and the depreciating currency value. A savings account's really not going to get you anywhere nowadays. Whereas investing in general, or just investing in an index fund, gives you an attractive rate of return in comparison to this. So if we put them two polar opposite things, a savings account and an investment into an index fund, for an example, it makes the index fund extremely attractive. For an example, the index fund could give you a few percent each year and give you some profit on your savings. It's a lot more powerful than a savings account, as you're saving and compounding your investments. It may even be close to 10% for the rate of return each year if you know exactly what you're doing. For an example, in the past, the S&P 500 has had around a 10% rate of return, but there's been years where it's been really high, from 13 to 14%, and sometimes a little bit higher. It really depends how it performs from year to year, but the average is about 10%. Now, index funds, a lot of them are very old, especially the S&P 500, which was actually created in 1957. This means that there's so many years of data in the history to show that they outperform the market. So for an example, Warren Buffett, which was one of the best investors, he actually fenced a 10-year bid, and this was a bet against high-cost hedge funds to challenge them to see if their investments could outperform the market. So what they were investing in, could that outperform the S&P 500 index, for an example, and offer a better rate of return in that duration or time period. He obviously fenced $1 million for this because he was extremely confident, which is only a percentage of his net worth because he's a multi-billionaire, and of course he was right, and the hedge funds could not outperform the index, which is what makes index funds and ETFs extremely powerful. Okay, so next we're going to move on how to actually invest into index funds, what you need to get started, and what are the required steps to go forward and jump in to get invested. First of all, you're going to need a brokerage account, which can be set up online on any kind of online broker. There's a few different recommendations which I'll go through, and one which I actually do have an affiliate link for that you can click down in the description, which I do actually, believe it or not, personally use for my investments. Now, a lot of people in these videos, they'll give you all these links which will make them money or give them a special deal. In this case, I do actually use the service that I'm giving you the link for, so using it would be very much appreciated, but be confident and know that this is actually a trusted service which I use. This personal service which I use is the FreeTrade app in the UK. The reason why I chose this is because it has the most attractive monthly flat rates for investing. So a lot of different apps, they'll give a percentage on each investment or transaction you do, and there'll be a small percentage charge on each investment or transaction you do, which can stack up in terms of fees, and it can get a little bit costly depending on how much you actually have to invest. This is not really something which I liked or was interested in, so I actually got the FreeTrade app a little bit more than a year ago to start investing. If you use the affiliate link which is down below, it does actually give you a chance to get a free share, which could be a random value, and for example, you could get something really good like an Apple or an Amazon share which has an extremely high value, or you could get a low cheap share, but it'll still kick off your investment portfolio, so why not do it? But there is a disclaimer that if you do use this link, it will grant me a free share too of a random value, so it's beneficial for both of us. Now, for people who are watching in America, aka the USA, USA, you do have some options in terms of brokerage services. I would personally recommend the Vanguard website because it's trusted by some of the most richest people, and it's a service which has been running for a long time. And they actually do have their own indexes that you can invest in too. For an example, Vanguard's S&P 500 is one of the most popular index funds that you can invest in. So on FreeTrade, when you have the FreeTrade app on your phone, there is a few different options you can pick in terms of the different accounts on offer. So for an example, you have a general investment account, which is completely free, which has up to £12,300 annually, which you can invest before being subject to any kinds of capital gains tax. So this is completely tax-free investments. Or you have the stocks and shares ISA, which is the most attractive account, which I personally pay for, and this is only £3 a month. So it's just one monthly flat fee, and there's no percentages or fees on transactions or investments like a lot of other different services, which makes it so attractive and powerful. This is extremely tax efficient because you can actually invest up to £20,000 annually with no tax at all. Now, I personally chose to use FreeTrade because the monthly fee is extremely small in comparison to what a lot of the other services will charge you when you do different investments, because all those fees obviously do add up. It's a pretty simple app to use. You basically just verify and make sure you're a real person. I believe you do have to verify with a passport or some kind of photo ID through the app, but I do remember it being an extremely easy process. And once you're done, you just set up your bank details. You can do a bank transfer or a Google Pay payment to top up your account, and then you can use that money to invest in any shares. Obviously, the stock market opens at certain times during each day, but you can also queue buy orders at any time of the day, which will be fulfilled when the stock market opens. FreeTrade does offer both UK and USA based companies which you can invest in, with thousands from the London Stock Exchange, NYSE, and more, with a huge range of ETFs and investment trusts. So there's a very diverse amount of things you should invest in on FreeTrade. Anything from green energy ETFs to investing in a game like Roblox, or investing in some of the more powerful solutions to the current pandemic going on in the world. So the next section or chapter is which index funds should you actually invest in? What are the most powerful and what are the more safer ones to choose? There's many different popular ones which you can invest in, with the most popular being the S&P 500, which tracks the 500 most highest performing USA companies, which can change a little bit from year to year depending on the different metrics and the performance of said companies, and the FTSE 100, which tracks the top 100 companies from the London Stock Exchange. There's also the Nasdaq 100, which tracks 100 of the largest domestic and international non-financial companies on the Nasdaq stock market. So these are the three top main ones that you can invest in, but there is a lot more and many different custom ones which track different markets in the industries. So for an example of some of these, if you are on FreeTrade, for an example, there's a few different ones like green energy ETFs that you can invest in, and it'll spread your investment across many different green energy and electric companies, for an example, pharmaceuticals, and many other different niches. It really depends on which market you want to get into. Now, currently my investment is basically just solely in the S&P 500. I do have a tiny bit in the FTSE 100, but most of the portfolio spreads across the S&P. Now, this is a great investment, particularly the S&P 500, because it's a good sole choice if you don't wish to invest in many different ETFs or multiple funds, as it has an average annual rate of around 10% since inception, i.e. when it was created, performing considerably higher in the past few years, like I mentioned a little bit earlier in the video. So whether you're on FreeTrade or not, I'd recommend either the Vanguard S&P 500 or the iShares S&P 500, which is the one that I personally use and am invested in right now. So how much rate of return will you make on an investment, or how much profit, if you want to call it, will you make on your investment? So the return of your investment is basically based on the amount of time you have, the amount you have to invest, i.e. the capital you're going to put into it, and the fund which you choose to invest in and how that fund will perform. So let's do a short case study or a calculation of how much you could expect to earn and receive on the S&P 500 if you choose to invest. Now I'm going to show you a very small amount that someone like me or a young person or a student could very easily invest and see what rate of return you'll get. So I do have some notes on my laptop which I've been referring to, a little bit of a script throughout this video. So let's give an example. So I'll give an example of investing a small amount that's very believable for a young person with little money. So if you're a 20-year-old person, a man or a woman who's around 20, and you choose to invest in the S&P 500 right now, and you choose to invest just $1,000, I'm going to use dollars because most of the people on the internet know the value of the dollar and it's kind of the internet's currency. If you choose to invest just $1,000 initially, and then a further $200 every month for the next 40 years, which obviously would bring you to around 60, which is close to the retirement age or just before in many different countries. Let's just say that this S&P 500 had the average annual rate of return of 10%, so all of your investment would go against a 10% return. With an expected 2.9% rate of inflation, you could expect to have invested around $97,000 in total during this 40-year period, with simple interest of $196,324 and compound interest, so that's the amount of interest which your investment is going to stack up over time, over those years as it gains value and it gains that 10% effect. That would be a compound investment rate of return or interest of $870,856. So that's some crazy numbers, but that's over a 40-year period of constant investing. So if you can't do the maths in this situation for this formula, your initial investment, although it seems extremely tiny, over time, by the time you're 60 years old, would total to $1,164,181. This would basically make you a millionaire, although it's an extremely slow process to accrue to get to this point. But it's more believable to the general population if you don't have a business or any kind of crazy method to achieve this. Of course, this would just be a very smart, cheap investment, which is possible for nearly anyone to do. Someone like the average person who isn't rich, this would be very easy for any of us to do. However, I wouldn't recommend this sole investment to be your main hustle or main source of income, for an example, because you do have to have a main job to do this investment, and also it's an extremely slow rate of return. Even though it's better than any kind of savings account, you are putting a lot of time into this and you are waiting many years for this investment to grow. For an example, this should be money that you're not going to have to touch. So you can't take this money out and use it for any kind of emergency. You can't take this money out to spend on something that you want or something that you like, because then obviously you're not going to get any return on it. So this is money that you can expend without feeling any kind of loss. So it's going to be money that you can invest that you're not going to take out of the account. So the next point would be, what is compounding? So if you didn't understand, compounding is the ability for an asset to generate earnings over time. So this is that very slow time process. So for an example, the more time you have, i.e. the younger you are, and the more years of life left or before the retirement period that you have, the more chance your initial investment has to compound. For an example, the initial investment of $1,000 will gain 10% per year on average, with the monthly investments also attributing to this growth with the same percentage of return and adding to the initial amount that you put in, which will also compound too and consistently stack over time. So depending which index that you invest in, you may also be subject to certain dividends. So let's just explain the simple concept of dividends. What are they? And why are they useful too? So they're a type of payment issued to shareholders by companies based upon their annual earnings, which are usually very small amounts per share, especially if you haven't invested much. It's not going to accrue you much. For an example, if you watch some videos on YouTube where people have invested a few $100,000, they might get like $10,000 a year or every quarter in dividends, which is an extremely large amount, but the amount they put in obviously makes sense. So if you put in a very small amount, like a few hundred, don't expect to get much back in dividends. So these are usually small amounts per share, which are issued a few times a year, which is obviously dependent on when the company issues them. And the more shares that you own, the more dividends which you can accrue over time, which may also add to your profit or the return, which we're talking about, which you can add to the final figure. Again, depending which index you specifically invest in, this may be a little bit different. The index that you invest in may automatically reinvest your dividends into the fund for further shares, or they may give you the dividend payment straight into your account and then you can manually buy more shares yourself. Now, we're not really focusing on the return of any dividend payments, we're focusing on stacking up our shares and letting it compound. So I'd recommend investing in a fund which automatically reinvests your dividends into the index to give your portfolio more shares in it, or manually do this yourself. So to sign up for FreeTrade, do check out the description. There will be a link down there below, along with anything else that's useful, like Audible and other random links down there for useful productivity. And if you have any questions, do feel free to ask, and I will try and get back to you as soon as possible. I do plan to make some more guides on investing because it's a very interesting topic, so do click subscribe and follow the page if you want to learn more.